Okay, hello everyone. Good afternoon. So for today, we are going to continue our discussion. So I apologize if you hear any background noise. So let's continue. So we are still on chapter 7, financial ratios. Pumanata sa liquidity ratio. So what is the difference? The difference between liquidity and leverage. Okay, from as what I had discussed in my prior lecture video, liquidity ratio measures more on the short term. Okay, short term nato ng financial position in which we have liabilities, we have assets. How easy can we convert our assets into cash? How easy or how solvent are we when it comes to paying our liabilities? Now, but are ready to cash? Do we have very good standing in our working capital? So that is liquidity ratio. So the next type of ratio we need to discuss is leverage ratio. So leverage ratio is, okay, it is also known as capital structure ratio. Okay, again, capital structure ratio. So these ratio indicate the long-term solvency of a firm and indicate the ability of the firm to meet its long-term commitment. So more on the long-term solvency na siya compared sa liquidity. So long-term nimo nga ability, your ability of the company to pay mostly lang yapon liabilities and also your assets too. So more on we have long-term commitments. So most of our long-term commitments are composed of loans. Okay, atong loans, atong capital, loan nato sa atong assets, and so on and so forth. So we have at least two commitments here. We have repayment of principal on maturity. So that means na more on our capital. Marami total, most of the time we need to source out funds. And by sourcing out funds, we need to take loans. So mag-use ta or manghiram ta og capital. So with that, we need to pay the principal amount or the original amount. And also the interest, okay? Lahi ang original o the interest in ginabaran. So, how committed are you? How reliable are you to pay those, let's say, capital ni mga use? It could be in installments at various due dates. So, murag, I guess, familiar mo sa installment nga type in which every month siguro ginabayaran with a specific interest rate and so on and so forth. So that is for leverage ratio. And also, again, periodic payment of interest during the period of loan. So more on loaning, how committed are we? How reliable are we when it comes to paying our debts in short? So that's for leverage ratio. So we have different ratios here. So medyo daghan siya types, at least 5 ka types. Actually, mas daghan pa mas specific, but we'll just discuss the main leverage ratios. We have debt equity ratio, proprietary ratio, debt to total capital ratio, interest coverage ratio, and debt service coverage ratio. So these are the ratios that are part or under our leverage ratio. So more on our equity, our capital, our assets, and interest. So let's discuss the first ratio. So this is debt ratio or debt equity ratio here. So this ratio now, it indicates the relative proportion of debt and equity in financing the assets of the firm. So it is calculated by dividing long-term debt by shareholders' funds. Again, this is more on imong utang and imuhang equity when it comes to financing imuhang firm. So it could be from need nimo magbuy og new machine or need ka og capital itself for your business. So this is where we are going to divide kato atong debts, long-term debts. So probably more than a year or more than 5 years. So good as long-term na daw na siya nga utang. Okay, probably dako kay nga amount ang imong use. So in order to pay that down, you need to pay it through your shareholders funds. So imuhang at least halin nimo, okay, as a shareholder, the total moral amount imo siyang i-divide sa long-term na mga debt, sa total long-term debt. So that's how you'll get the debt equity ratio. Here it is. Again, long-term debts over shareholders' funds. So generally, financial institution favor a ratio is of 2 is to 1. So if possible daw, 2 is to 1 daw ang ato ang at least ratio or result nga ma-find. So in order for us to know that this is satisfactory, that we are really committed to pay our utang. So if possible, again, we can really pay our utang in the long term, especially if we have enough shareholders funds or good as halin or imuhang dividends sa imuhang company. But however, this standard should be applied having regard to size and type and even the nature and degree of risk involved. So if possible po, medyo dili man gud siya ma-follow daw at some type of businesses. Lahi man taog nature and types of business. So it still depends, okay? So the first thing to consider is unsa kada for ang imong company, unsa imong nature sa company, and how risky would it be. Kaya mostly needed magud ato ang shareholders funds, so good as working capital yapon siya. But ato siyang gitagak nga gipambayad lang sa utang. And that's still okay. But again, depende yun sa imo. What if needed din nimo ang imong shareholders fund for operational activities? So, unsa lugar imong ipambayad sa long term? And so on and so forth. So most of the time, the higher the debt, the probably the bigger or kada og nature ang imong business. So that is for the first one. So we have long-term funds here and short shareholders funds. So what are the types of the long-term funds? So these are long-term loans, whether secured or unsecured, like debentures, bonds, loans from financial institutions, and so on and so forth. So more on loan siya in general. So depende kung hagikan nga loan, probably daw sa bonds from other companies, loans daw nimo sa financial institutions such as bangko, I think mga bangko man or cooperatives and so on and so forth. So that is long-term fund. Next is shareholder funds. So these are equity share. So equity share capital plus the preference share capital plus reserves and surplus less the fictitious assets such as preliminary expenses, past accumulated losses, discount on issue of shares, and so on and so forth. So shareholders funds is more on imuhang equity share based on the dividends that you had gained at the end of the year, okay, from your operations. So with that, giminus ng tong fictitious assets daw, mostly your expenses and other losses na dili siya part sa imong equity shareholder fund or automatic siya nga i-deduct sa imong funds. So that's it for that equity ratio. So again, more on how solvent or how reliable are you in paying your utang, ang imuhang funding, okay? More on capital, imuhang capital or asset siguro nga debt, okay? Any utang that you have. So next is proprietary ratios. So this ratio indicates the general financial strength of the firm and the long-term solvency of the business. So again, this ratio indicates the general financial strength of the firm. So more on how strong your company is when it comes to the long-term solvency in your business. So this ratio is calculated by dividing proprietors funds by total funds. So again, your financials, it is more on your funds over the total funds, like how much share will you get from the total funds or assets there is. So proprietary ratio is also called the shareholders fund. So same lang sila. Proprietors fund or shareholders fund divided by the total funds. So how strong is your financial nga kuan siguro, financial nga operations in which kusog kayo mo ma-generate of funds to bawi your shares in the company. So this one focuses more on how reliable are you to pay your investors, your shareholders when it comes to sourcing out funds. So that is proprietary ratio. So it is where a rough guide of 65 to 75% DAO is advisable. So based on the total assets that you have, how reliable are you to pay your, let's say, investors, your shareholders when it comes to the operation of your businesses. So at least daw 65 to 75% ang mabalik sa ilahang funds. So that's when mostly our investors or shareholders will commit to your company. So actually, dili man pud sila mag-base. Ila sang tan-awon if how good are you in paying them. So what is your proprietary ratio? So based on current assets now, so nakay kaning mga assets or money, and based sa ilahang, let's say, share, mo po nilang gihatag na share. Okay, that means nga good as mabawi nila at least 75 or 65% daw sa ilahang gi-invest from your company. Probably in the long term or in the short term, so it depends. But at least, sure sila nga mabawi ang ilahang invest in mga company as shareholders. So these are the terms that is needed, the proprietors funds. So the same lang sila sa shareholders funds. Again, it is from the equity share of your company. Next is total funds, are all fixed assets and all current assets. So currently, it can be calculated as proprietors funds plus long-term funds plus current liabilities. So that is what it meant by the total fund, more on fixed assets, any assets that you have, probably cash to katong fixed assets. So anything that can be converted to cash in the short and long run. So it can be added plus the current liabilities too. Apil ang imuhang utang po. So that is the total funds that you have. So it can be calculated now as proprietors funds plus long-term funds plus current liabilities. So ipang-add sila. So that's the second type of ratio under leverage ratio. We have again debt ratio based on your utang, how reliable are you to pay your utang. Next is how reliable are you to pay your investors or your shareholders. Next is debt to capital ratio. So what is debt to capital ratio? So in this ratio, the outside liabilities are related to the total capitalization of the firm. So it indicates what proportion of the permanent capital of the firm is on the form of long-term debt. So more on outside liabilities that is related to your capitalization of the firm. More on kuan lang gyapon siya sa imuhang utang. So how reliable are you to pay your outside liabilities? Ang imuhang utang, especially nga capital. So how reliable are you to pay it? So it indicates more on the permanent capital, imong firm o imuhang long-term debt. So this is its formula. So debt to total capital ratio. So imo daw utang nga focus on your capital. So let's say nangutang ka og 5 million to tukod a business. So 5 million is your long-term debt. Then you will have your shareholders funds plus long-term debt. So this is how you'll calculate the debt to total capital ratio. So let's say you have a, di ba yung long-term debt is 5 million. Muhada yung shareholders fund is at least 3 million. So 3 million plus 5 million, that is 13. So 5 over 13. So conventionally daw, a ratio of 2/3 is considered satisfactory. So if possible, you'll have, I hope you can, di ba ninyo makita, siguro nag-calculate ko. 5 divided by 3. So, okay. So that's it. If possible daw, two-thirds kay considered satisfactory. At least two-thirds sa imuhang capital nga gina-borrow is imuhang makaya og pay. Okay? So that's how it is, especially when it comes to banks. Diri sila gatanaw how what is your financial position when it comes to debt to capital nga ratio. Ilang i-check, be? If 5 million imong utangon, then mo ni imong funds nga available, then at least two-thirds. Pag-calculate din nga hala, wala na lapas og two-thirds. So dili lang sa kanang utangon, Mr. Kani, kay murag dili pa man nimo makaya og pay, di pa mi sure if makaya pud nimo. So that's again mostly investors would look sa leverage ratio. Dili sila gatanaw always kay ilamang money imong gamit. Let's say siguro nga again nanghulam ka og money sa bangko, tan-awon din ni sa mga bankers. Hala imong debt to total capital na ratio is very low. 1/2 lang imong makaya og pay. So that means na i-reject na mo imong application for loan. So that is an example. So next is the interest coverage ratio. So what is interest coverage ratio? So it measures the debt servicing capacity of a firm insofar as the fixed interest on long-term loan. Long-term loan is concerned. So more on debt servicing capacity. How good are you, Japon, when paying your utang at the same time your interest. Okay. Kung mag-utang ka in a business, that means ma-expected ka nga na interest. And they are two separate entities or accounts. Kaya nga no, na may principal amount and interest na amount. So it shows how many times the interest charges are covered by EBET, out of which they will be paid. Okay, EBET. Okay, so it is covered by EBET. So EBET means earnings before interest and taxes. So if possible daw, the interest coverage ratio shows how many times the interest are charged, especially it is under the interest. Okay, especially katong pa daw ning it is covered by earnings. Okay, imo daw halin before gi-minusan og interest and tax. So earnings before interest and taxes. So out of which they will be paid. So this is its formula, interest coverage ratio. So earning before interest and taxes divide interest. So again, this part is where same lang gyapon sa bankers. Ila gyapon ni gina-check. So if magpatong daw sila o given nga interest, how let's say how possible or how reliable are we to pay them, especially based on your earnings before gilas ang imong interest and taxes, like other interest and other taxes. So divided by the interest nga imong ay gusto nga achieve or ilang i-apply. So that is interest coverage ratio. Mostly investors and bankers will look at this ratio and they'll say and look whether it is satisfactory or not for you to be approved sa imong, let's say, loan sa imong capital. So a ratio daw of at least 6 to 7 times is considered satisfactory. So if it is about 6, so probably approve ang imong loan. Or if it is below 6 or mga 5, 3 lang, that means na, okay, your performance is not good. You need to earn higher, okay? You need to earn bigger. Okay, most of the time, when it comes to mag-nita of additional capital or probably capital itself, na magka-proposal, di ba? Imo din ang ibutang imuhang expected or let's say, kamulo na ka og imuhang earnings before pa daw gi-minus imuhang interest and taxes. So ilan nang i-check? Okay, based imuhang data kani ang imuhang earnings. And mo ni atong possible nga interest ni hatag sa inyo mga 5%. Pag divide nila, hala kuan 3 at least 3 times ra daw siya nga kuan. Ang imong ratio kay at least 3 below 3. So that means you need to earn more, okay? you need to earn more in order to big approve sa imong application for another capital loan. So that is under interest coverage ratio. So the higher the ratio, the greater the ability of the firm to pay interest out of its profit. So again, the higher the ratio, so 6 to 10 or above, the higher imong ability nga mo bayad sa imong utang, especially the interest itself based on your profit sa imong earnings. But too high a ratio may imply lesser use of debt and or very efficient operation. At the same time, it also implies daw nga you have a very good na operation, very good, yeah, most likely very good operation in which dako you tag earning to the point na dili na kayo bothersome sa imong interest. Okay? So, dili na kayo siya kuan. Sakit sa imong part mo bayad og interest. Kaya dako yung kaghalin. So, that is what it meant by interest coverage ratio. So the fifth one would be the debt service coverage ratio. So same siya sa interest coverage. So what is debt service? Debt service coverage ratio. So it is a more comprehensive measure to compute the debt servicing capacity of the firm. So it shows how many times the total debt service obligations consisting of interest and repayment of principal in installments are covered by the total operating funds after payment. So this is more on how many times now you pay your debt service obligation. So your debt service obligation is composed of nana siya interest, nana siya debt, depreciation, and other non-cash nga expenses. In order to okay, in order to pay your interest and principal nga installment. So more on repayments. More on repayments nga kahitabo. So debt service coverage. So how good are you to pay your service coverage, let's say sa imong company. So more on we have EAT here. So this is the formula. EAT means earning after tax. So gilas na imong taxes, gilas ng interest, gilas ng taxes but giad ang interest, and also the depreciation and other non-cash expenses divided by the interest plus principal installments. So more on lang yapon how you pay the service coverage they had provide. Let's say for example, sa imong business. So nakipagkontrata ka with a given nga service. Kani nga service is kani sila ang nag-prepare sa imong extension building. So extend ka sa imong building or store. So with that, imo siyang good as giutang ang ilang service. So that's what we call debt service. So with your debt service, you are going to pay, okay? Pay them with the interest, with the other things. Okay, inyong mga kasabutan is through installment, paying installment. So you need to pay the principal amount plus also the interest. So it would be based again on your earning after tax. The appeal na po ang inyong depreciation and other non-cash expense over the interest and principal installment. So that's how you'll get the debt service ratio. How good are you at paying such services? Kay imo man siyang good as utang na service. Kay kuan wal ka mula kag operate or use sa imong use the money in order to reconstruct a building. Kamula pud ka og pay sa ilaha. So this one is most likely sa kuan lang siya nag-focus diapon sa imong earnings and also the whole amount ninyong nasabutan. At the same time, ang interest. Okay, so generally, financial institution consider 2:1 as a satisfactory ratio. So before daw sila, let's say, na nakay na kontrata or nakay kuan, gi-contact, yung gi-contact ng construction service kay yung sila nga kuan, makaya na mo o construct sa imong building for kanina year. Sabot na mo. But, amo sang i-check if makabayad gud ba mo sa mga services. So, mostly financial institution na po. Kani mo gud siya ratio again these are the bases for them to know if how reliable are you or how good is your financial position to pay them. So this is what we call leverage ratio. So more on improvements, more on you kind of financing your company for expansions in your business and other nga mga things that needs additional assets or funds. So with them, pagkakita nila nga, oh, tsada ang inyong ratio, 2:1. Mas dako ang inyong earnings compared sa kuan. And makaya din yung bayad. So, among i-approve ang ato ang kontrata. So, sugot mi nga kami tukod sa inyong company. Given nga mo niya itong agreement. And based po sa inyong financial performance, sa inyong debt service coverage ratio, very good mo nga kuan nga business. So, we'll have a contract with you. So that's what will happen. So those are the leverage ratios na available. So again, leverage ratio is more on we adding more funds, adding more services in our business. So from debt equity and total capital, actually same ra sila, more on additional capital for our business. While proprietary ratio is how same lang yapon, but how reliable are we to pay our investors, our shareholders? While interest coverage and debt coverage, service coverage, focus more on how reliable also are we to pay our mga utang or mga mostly utang, okay? Based on our earnings. These are mostly based on our earnings, okay? Kung we talk about utang, it would always be based on mga earnings. I think kabantay mo, or kadungog na mo nga. Before mo i-approve, let's say sa isa ka loan, need pa, ang number one requirement is your payslip. Number one requirement is imong income. Sa imong business siguro, or yes, imong sweldo. Inga na gid always number one. Ila man nang i-assess if kuan ba ka, eligible ba ka or kanang liable ba ka to pay such commitments. Makaya ba nimo bayad given nga mo na requirements, given nga more po dahil mong income. So that is what leverage ratio is all about. Mostly our investors would really look into this report, okay? Based on our financial statement and analysis, they'll look at your leverage ratio and they'll assess you if ilang i-approve ang inyong applications. Mostly on loans, mostly on availment, okay? Availment on assets or liabilities. So that's it for the second type of ratio. So let's continue. So I hope that's clear for you. So before that, let's have another rundown. So just another rundown sa ato ang topic today. In a minute, I'll try to share my screen. So I hope you can see my screen. So let's continue. So let's try to write down the second type of ratio. Oh no, in a minute. Okay, so let's continue. So this is actually the second type of ratio. So we have here leverage ratio. So I hope it's clear. Maklaro ninyo ako lagi. So siya i-highlight of yellow. So let's start off with the first one. Okay, so we have the first type. We have debt equity ratio. So again, ratio. So this is written as this one. So I'll just use acronyms. So that would be DEB equals to your long-term debts, LDB, and your shareholders funds. So we'll have an example. What if your long-term debt is 5 million, then your shareholders fund is at least 1 million. Okay, 1 million. So that is good as dako pa siya. Masyag 5:1. So that means na makaya po din siya bayad. Medyo okay lang siya mabayaran na nimo. Like example na siya. Or something like that. So let's have another example. What if we have 15 and 5 here? So that means we have 3:1. So it is still you're still liable. So, pwede ra ka magkabayad sa ilaha. Okay? Mara siya change lang or control. So again, this would be your shareholders fund and your long-term debt, 15 million, and yung mga yung shareholders fund per year is 5 million. So it is very feasible. You are very reliable when it comes to paying your debt equity na ratio. So I'll just put a right example with X. So again, this is its formula. So that's just a quick rundown. So let's continue to letter B. So letter B would be our proprietary ratio. Okay. Ratio. So proprietary ratio, we have we have this formula. So I'll just put PR is equals to proprietary funds or shareholders funds over total assets para mas dali rin ninyo ma-remember. So this is its formula, more on shareholders fund, proprietary ratio. So let's have a simple na example. Just put example here. So at least 65 to 75 daw nga ratio ang advisable. So let's have an example here. Imuha daw funds nga available is